rapid pace next year, driven by rising sales, an ongoing need to replace obsolete or worn-out equipment, strong corporate balance sheets, and low financing costs. In the public sector, the tax receipts of state and local governments have started to recover, which should allow their spending to stabilize gradually. The combination of federal fiscal stimulus to overall growth, the contribution, is expected to decline steadily over coming quarters, but not so quickly as to derail the recovery. Continued solid expansion among the economies of our trading partners should also help to support foreign sales and growth in the United States. Although output growth should be somewhat stronger in 2011 than it has been recently, growth next year seems unlikely to be much above the long-term trend. If so, then net job creation may not exceed by much the increase in the size of the labor force, implying that the unemployment rate will decline only slowly. That prospect is of central concern to economic policymakers because high rates of unemployment, especially longer-term unemployment, impose a very heavy burden on the unemployed and their families. And more broadly, prolonged high unemployment would pose a risk to consumer spending and hence to the sustainability of the recovery. Let me turn now to the outlook for inflation. Generally speaking, measures of underlying inflation have been trending downward. For example, so-called core PCE price inflation, which is based on the broad-based price index for personal consumption expenditures and excludes the volatile food and energy components from the overall index, has declined from approximately 2.5% at an annual rate at the early stages of the recession to an annual rate of about 1.1% in the first 8 months of this year. The overall PCE price inflation rate, which includes food and energy prices, has been highly volatile in the past few years, in large part because of sharp fluctuations in oil prices. However, so far this year, the overall inflation rate has been about the same as the core inflation rate. The significant moderation in price increases has been widespread across many categories of spending, as is evident from various measures that exclude the most extreme price movements in each period. For example, the so-called trim mean consumer price index has risen by only 0.9% over the past 12 months, and a related measure, the median CPI, has increased by only 0.5% over the same period. The decline in underlying inflation importantly reflects the extent to which cost pressures have been restrained by substantial slack in the utilization of productive resources. Notably, the unemployment rate remains fairly close to last fall's peak and is currently about 5 percentage points above the rates that prevailed just before the beginning of the financial crisis. Engaging the magnitude of prevailing resource slack and the associated restraint on price and wage increases, it is essential to consider the extent to which structural factors may be contributing to elevated rates of unemployment. For example, the continuing high level of permanent job loss may be a sign that structural impediments, such as barriers to worker mobility or mismatches between the skills that workers have and those that employers require, are hindering unemployed individuals from finding new jobs. The recent behavior of unemployment and job vacancies, somewhat more vacancies are being reported than would usually be the case given the number of people looking for work, is also suggestive of some increase in the level of structural unemployment. On the other hand, we see little evidence that the reallocation of workers across industries and regions is particularly pronounced relative to other periods of recession, suggesting that the pace of structural change in the economy is not greater than normal. Moreover, previous post-World War II recessions do not seem to have resulted in higher structural unemployment, which many economists attribute to the relative flexibility of the U.S. labor market. Overall, my assessment is that the bulk of the increase in unemployment since the recession began is attributable to the sharp contraction in economic activity that occurred in the wake of the financial crisis and the continuing shortfall of aggregate demand since then, rather than to structural factors. The public's expectations for inflation also importantly influence inflation dynamics. Indicators of long-term inflation expectations have generally been stable in the wake of the financial crisis. For example, in the Federal Reserve Bank of Philadelphia's survey of professional forecasters, the median projection for the annual average inflation rate for personal consumption expenditures over the next 10 years has remained close to 2%. Surveys of households likewise show that longer-term inflation expectations have been relatively stable. In the financial markets, measures of inflation compensation at longer horizons, computed from the spread between yields on nominal and inflation-indexed Treasury securities, have moved down on net this year but remain within their historical ranges. With long-run inflation expectations stable and with substantial resource slack continuing to restrain cost pressures, it seems likely that inflation trends will remain subdued for some time. To evaluate policy alternatives and explain policy choices to the public, it is essential not only to forecast the economy, but to compare that forecast to the objectives of policy. Clear communication about the longer-run objectives of monetary policy is beneficial at all times, but is particularly important in a time of low inflation and uncertain economic prospects, such as the present. Improving the public's understanding of the central bank's policy strategy reduces economic and financial uncertainty and helps households and firms make more informed decisions. Moreover, clarity about the goals and strategies of the central bank can help anchor the public's longer-term inflation expectations more firmly and thereby bolster the central bank's ability to respond forcefully to adverse shocks. The Federal Reserve has a statutory mandate to foster maximum employment and price stability, and explaining how we are working toward those goals plays a crucial role in our monetary policy strategy. It is evident that neither of our dual objectives can be taken in isolation. On the one hand, a central bank that aimed to achieve the highest possible level of employment in the short run, without regard to other considerations, might well generate unacceptable levels of inflation without any permanent benefit in terms of unemployment. On the other hand, a single-minded focus by the central bank on price stability with no attention at all to other factors could lead to more frequent and deeper slumps in economic activity and with little benefit in terms of long-run inflation performance. Recognizing the interactions between the two parts of our mandate, the FOMC has found it useful to frame our dual mandate in terms of the longer-run sustainable rate of unemployment and the mandate-consistent inflation rate. The longer-run sustainable rate of unemployment is the rate of unemployment that the economy can maintain without generating upward or downward pressure on inflation. Because a healthy economy must allow for the destruction and creation of jobs, as well as for movements of workers between jobs and in and out of the labor force, the longer-run sustainable rate of unemployment is greater than zero. Similarly, the mandate-consistent inflation rate, the inflation rate that best promotes our dual objectives in the long run, is not necessarily zero either. Indeed, committee participants have generally judged that a modestly positive inflation rate over the longer run is most consistent with our dual mandate. The view that policy should aim for an inflation rate modestly above zero, by the way, is shared by virtually all central banks around the world. Several rationales can be provided for the judgment about a positive inflation rate, including upward biases in the measurement of inflation. A rationale that is particularly relevant today is that maintaining an inflation buffer, that is, an average inflation rate greater than zero, allows for a somewhat higher level of nominal interest rates, which in turn gives the Federal Reserve greater latitude to reduce the target federal funds rate when needed to stimulate increased economic activity and employment. A modestly positive inflation rate also reduces the probability that the economy could fall into deflation, which under some circumstances can lead to significant economic problems. Although attaining the long-run sustainable rate of unemployment and achieving the mandate-consistent rate of inflation are both key objectives of monetary policy, the two objectives are somewhat different in nature. Most importantly, whereas monetary policy makers clearly have the ability to determine the rate of inflation in the long run, they have little or no control over the longer-run sustainable unemployment rate, which is primarily determined by demographic and structural factors and not by monetary policy. Thus, while central bankers can choose the value of inflation they wish to target, the sustainable unemployment rate can only be estimated and is subject to substantial uncertainty. Moreover, the sustainable rate of unemployment typically evolves over time as its fundamental determinants change, whereas keeping inflation expectations firmly anchored generally implies that the inflation objective should remain constant unless there are compelling technical reasons to change it, such as a change in the methods for measuring inflation. In recent years, the Federal Reserve has taken important steps to more clearly communicate its outlook and its longer-run objectives. Since the fall of 2007, the Federal Reserve has been publishing the Summary of Economic Projections, or SEP, 4 times a year in conjunction with the FOMC minutes. The SEP provides summary statistics and an accompanying narrative regarding the projections of the FOMC participants, that is, the board members and Reserve Bank presidents, for the growth rate of real domestic product, the unemployment rate, core inflation, and headline inflation over the next several calendar years. Since early 2009, the SEP has also included information about FOMC participants' longer-run projections for the rates of economic growth, unemployment, and inflation to which the economy is expected to converge over time. Because these projections are made in the absence of further shocks and under the assumption of appropriate monetary policy, by definition, they correspond to the Federal Reserve's objectives in the longer run. In particular, they correspond to FOMC participants' longer-run projections for economic growth, unemployment, and inflation, corresponding to the potential growth rate, the longer-run sustainable rate of unemployment, and the mandate-consistent rate of inflation. The most recent release of the SEP was in June, and I will refer to those projections here, noting that new projections will be released with the minutes of the next FOMC meeting in early November. The longer-run inflation projections in the SEP indicate that the FOMC participants judge the mandate-consistent inflation rate to be about 2% or a bit below. In contrast, as I noted earlier, recent readings on underlying inflation have been approximately 1%. Thus, in effect, inflation is running at rates that are too low relative to the level that the committee judges to be most consistent with the Federal Reserve's dual mandate in the longer run. In particular, at current rates of inflation, the constraint imposed by the zero lower bound on nominal interest rates is too tight. The short-term real interest rate is too high, given the state of the economy, and the risk of deflation is higher than desirable. Given that monetary policy works with a lag, the more relevant question is whether the situation is forecast to continue. In light of the recent decline in inflation, the degree of slack in the economy, and the relative stability of inflation expectations, it is reasonable to forecast that underlying inflation, setting aside the inevitable short-run volatility, will be less than the mandate-consistent inflation rate for some time. Of course, inflation forecasts, as of other key economic variables, are uncertain and must be regularly updated with the arrival of new information. As of June, the longer-run unemployment projections in the SEP had a central tendency of about 5 to 5.25%, about 1/4 percentage point higher than a year earlier, and a couple of participants' projections were even higher at around 6 to 6.25%. The evolution of these projections and the diversity of views reflects the characteristics that I noted earlier. The sustainable rate of unemployment may vary over time, and estimates of its value are subject to considerable uncertainty. Nonetheless, with an actual unemployment rate of nearly 10%, unemployment is clearly too high relative to estimates of the sustainable rate. Moreover, with output growth over the next year expected to be only modestly above its longer-term trend, high unemployment is currently forecast to persist for some time. Given the committee's objectives, there would appear, all else being equal, to be a case for further action. However, as I indicated earlier, one of the implications of a low inflation environment is that policy is more likely to be constrained by the fact that nominal interest rates cannot be reduced below zero. Indeed, the Federal Reserve reduced its target for the federal funds rate to a range of 0 to 25 basis points almost 2 years ago, in December 2008. Further policy accommodation is certainly possible, even with the overnight rate at close to zero, but non-conventional policies have costs and limitations that must be taken into account